that we can do when you open a sole proprietorship, so a company composed by only one person, is that you can run your business, so have already a position open with the Social Security, and that's the reason why you don't have to reopen again when you have an SRL, and exploit here the impatriate regime. That's the big thing. And the impatriate regime in 2024 has a deduction of 50% of your income. So 50% of your profit is tax-free. And we're going to apply my Social Security after the deduction. So the INPS, which is my Social Security, which in Italy is a big chunk, is calculated on my 50% of my profit, if I'm eligible for the impatriate regime 2024, and on my dividends, which are basically taxed at 32%, sorry, 58% of it, but we haven't made the calculation before. And this is the big thing. So you can use this instrument to either get dividend from your potential SRL that you have in Italy, but also from using the same structure to exploit the impatriate regime. So this is another thing that you have to keep in mind. And now I'm gonna give you another big important example of how useful are those sole proprietorship companies in Italy, because you can also optimize taxes when you own a company abroad and you are tax resident in Italy. So in general cases, when you have an Italian tax residency, you have to receive dividend from abroad. So you are in Italy, for example, and your company is abroad, foreign country, and your foreign company makes some profit and you want to withdraw dividend, and you have an exit tax, which is the withholding tax of, I don't know, 50%, 5%, or 0%. So this depends where your company is located. For example, if your foreign company is located in UK, you most likely will have a withholding tax 0. So you can withdraw your money tax-free because you're not resident there as a shareholder, and then those money goes inside the Italian territory, and inside the Italian territory they pay 26% because this is the flat tax for dividends. Now, what's going to happen here? In case your foreign company is subject to a withholding tax, a local withholding tax of 15%, for example, because this is the agreement between Italy and the country from where you have located your foreign company, then you have to pay 15% first, and then what remains, the net, goes inside the Italian territory and will be subject by other of this 26%. So for these specific cases, Italy doesn't apply the tax credit system when it comes to double taxation when we have the dividend situation. When you want to withdraw dividend and you're tax resident in Italy, you pay first the withholding tax there in a country, and what remains will be taxed at 26%. It's not really a sum of it. So it's not like 41% total, it's like 38% tax pressure, but it's still very high. How do we solve this problem if Italy doesn't apply the tax credit system on dividends? Well, we apply the sole proprietorship trick that we have seen before, and we become the only owner of this company which owns my company abroad. And what happened here? The thing is that I'm going to be taxed up to 15%, for example, on my foreign company, but when the dividend comes inside the Italian territory, I will be taxed only on 58% of it, okay? And since what remains, it's subject to the RPF taxation and not on this 26% flat. By convention, if I apply the RPF taxation, I can use my foreign taxes for tax credit. You see? So I can use this company to benefit from the tax credit system and reduce my dividend that's coming from abroad. So if, for example, I'm subject to 13% taxes in Italy, what can I do? Or let's make an example a little bit more easier. Let's imagine that my foreign company is withholding 10% taxes, okay? And I'm subject to 13% of RPF because I'm withdrawing the first 28,000 euro. Okay, from my foreign company. Well, I'm going to be taxed at 13% in Italy, not okay on this 28,000 euro, but then I have to also pay 10% from my foreign company because of my foreign company, and then I can use 58% of my 10% here to subtract it to the Italian taxes that I have already paid. So 5.8% of my 10% can be used to reduce the tax to pay to the Italian government, okay? So it's not gonna be, it's gonna be always 13% to Italian government, but 5.8% of it can be used as a tax credit, which is way, way better than have this sort of mitigation, which anyway reaches you a sort of 38% tax pressure, while here you're gonna have 13% plus 4.2% taxation, which is the maximum, could be 17% or something, okay? When you have this kind of structure. So I know the calculation a little bit complicated here. Maybe I didn't explain myself so well in this video because I know it's complex. This kind of calculation is very different from the 26% flat tax, but we have to apply this complex system to avoid to have this double taxation, which is basically cannot be avoided, okay? So, if you didn't understand correctly this point, I want to just give you a glimpse of what you can do with this kind of structure, with this kind of sole proprietorship companies in Italy. If you want to know more, if you want to check if this kind of structures might be applicable for your specific situation, write us at info@ESENtaxa.com, or even better, in the description below the video you will have our link to Calendly, so you can basically schedule a call with us. You can have 1 hour call consultation or 1 hour call consultation plus tax simulation, so we can understand exactly, based on your income, if this structure makes sense for you or not, if this structure can help you to squeeze your taxes down if you want to relocate to Italy, if you want to live in Italy and own some companies in Italy itself or abroad, without having this problem of double taxation on dividends. I hope I gave you all the information that you need to think about it, and if you like this kind of content, please subscribe the channel, notification bell, and like button to be always updated with our content. Thank you and see you to the next video.